Now, before we get into this, we'd like to remind you, please like, share, subscribe. And for those that are watching this on YouTube, sometimes I'll describe what's happening just because people like to listen to it on podcasts. And for those that are listening on podcasts, if you want a chart, just let me know. Happy to send it over. We're going to start to make those available on a delayed basis on our blog/research page. So if you want it, just let me know and we can send that over. So when we're looking at the loan side, so total loans are expected to drop at the U.S.'s largest banks. And when we look at the shifts in general, so card balances have dwindled and deposits have obviously gone up after the U.S. sent in more trillions. And businesses have also been reluctant to borrow until they understand where things are going, keep trying to maintain pace. And the lack of loan growth hurts for now. Susan Roth at Credit Suisse, adding that she expects bank managements to express confidence in prospects for a pickup in commercial loan demand, in particular as the pace of recovery accelerates. So again, at the same time, there's a huge surge of savings, which means that banks are going to have more money to lend, but they still are maintaining a very high level of bad debt expense. But even with that, they're going to have more money to push out. So it's just, it's still easy to get money. Rates are still low, even though we've come off the bottom. We're still very low on historical terms. So it's just going to be a matter of when do they get interested in starting to push that money back out into the world. And a lot of that can be, what does that recovery look like? And I thought this was a really good chart that the U.S. Bureau of Labor Statistics puts together. And this is looking at, data this goes back to 1994, but what are some of the differences? Like what are the flows, wages, employer behavior, confidence, utilization. So here, when we look at March, you can see that initial claims has started to normalize. As we get closer to the levels in general, but when we look at job finding, when you look at payroll, you're getting this weird weighting where hiring plans are starting to pick up, job availability's up, private quit rates are up, firms unable to fill jobs are up, but average hourly earnings growth is starting to mitigate a bit, even though it's getting a bit stronger because it's been getting weaker since 2019. Again, that wage compression that we keep talking about. So there's some pressure that remains with that. So this is kind of showing how it's still very one-sided, where the employer is willing, but wages just aren't there. Like work part-time for economic reasons, still high. Marginally attached workers, still high. Employment population ratio, still very low. Unemployment rate is, again, still within this obviously very low as well, is very high as well. So we're seeing some of these pressures that is making it very lumpy, if you will. So then when we look at the update to the Beveridge curve, you can see that, again, job opening rates are still very, very strong. It's just there's a dislocation, and the dislocation is suggesting that there is a skills gap, or the unemployed Americans are unable or unwilling to return to work. So is stimulus too high where it doesn't make sense to go back to work? Or do they not have the right skills, and the employer is like, look, there's so many people unemployed right now, I'm going to hold out for a better candidate instead of hiring you. And maybe eventually the person is like, look, the stimulus is running out, I have to go get a job. And the employer is like, I can't find anybody with the right skills, so I'm going to have to offer this person less and train them more. And again, this is that weird bifurcation that we're seeing in the market in terms of job openings versus the unemployment rate, and actually jobs getting filled, because there's a significant amount of dislocation in the market, which is shown in the earlier chart and now this one. So then when we look at, CPI is going up. We've seen that. We know it's going up, but is wage inflation going to go up? And that's when, okay, let's boil this down. So the median consumer price index, and I think it's worth obviously just defining what is inflation in general. So when we just just to describe from what it is, inflation is the rate at which the value of currency is falling, and consequently the general level of prices for goods and services is rising. So it's just are my eggs costing me $1 more in April versus March? Is my gasoline that we cover every week in the EIA $1 year over year and 2 cents month over month? Like, again, as that goes up, that is inflation. I'm paying more for that. And then obviously as currencies devalue, when we look at Turkey and the lira, Venezuela, that those inflation rates go up. So, but when we look at inflation or consumer price index, the CPI, the median CPI, so the idea is the median CPI and the 16% trimmed is to take away the tails on the biggest increases and the biggest decreases to try to get a trend set up, because you can see CPI is moved up, core CPI is moved up, but when you take away the tails, we've seen a median kind of balancing out here. So the trimmed mean is starting to go back up, and I think when we look at the 16% trimmed, that's going to continue to edge higher, and we're going to see the median CPI start to flatline and go back up as we see pricing start to get pushed through. So what this says to me is the CPI number is getting pulled higher by energy. Energy is the huge driver in the inflation numbers right now. But food is in there. Food is starting to drive up. Technology is starting to drive up. We're starting to see things that used to be cheaper starting to balance out and now pushing higher, which is why I think the median CPI and trim CPI starting to pull up is showing that some of the extremes on the tails are even though they will remain extreme, especially when we look at year over year, which is why we want to separate year over year versus month over month and try to look at the underlying noise. You can see that the trend is starting to pivot. And when we look at PPI, when we look at just stuff that normally has been deflationary and even starting to slow, is actually starting to pivot and go back up higher. So then when we think about companies mentioning inflation soared, again, this is based on B of A research. So the mentions of inflation are back to the levels that we saw in 2009 and 10, because they know what they're going to push through. These are corporations telling you they're going to raise prices. And the market is either going to accept it or reject it. And how much will the market accept before it's rejected? And how do you know if it's rejected? Well, you'll see earnings potential and earnings weaken, and that will show that the market has rejected some. So then when we look at the leading indicators, in terms of percentage of firms raising average selling price, again, they know what they're doing. They're raising prices. Their prices are going up. They're going to push through as much as they can. And that's why even though core CPI, when we look at the left-hand side, is still depressed, you can see just the general direction. The comment is always that it's transitory. Well, what is transitory? Transitory is the Texas freeze-off. That was transitory, measured in 10 days. Then you'll have a turnaround season, which is transitory, and that's measured in a month and a half. Transitory, when we look at the supply chain, the disruptions in the supply chain, COVID, spiking and then coming down, spiking again, reopening, it seems the transitory comment is longer and longer on a consistent basis, because we're only now starting to import inflation, and their prices are only rising behind it. So we've already seen increases in pricing, and now international prices are going higher, which means that we're going to import even more. Again, looking at just what is the leading indicator, and percentage of firms raising selling prices is approaching 30% and getting back to where we were in 2008. And based on what we're seeing in the backdrop, they're going to continue to try to push this up until the market rejects it. And when we look at month over month, so this is looking at consumer price index for all urban consumers, all items in U.S. city averages. This is looking at the percent change month over month. So this is, again, taking away the base effect. Let's not look at the base effect. Let's look at the month over month change. And you're continuing to see this drive higher, which is, again, and even this I think is still light, because wherever, they said that food is only up 0.1%. And I would love to shop wherever that basket is assembled, because I know that my food is not up 0.1%. But again, that's just I will say that as anecdotal, and I will just go to the evidence and say that this number is going to be much worse over time. So then when we look at ISM price index, average of services and manufacturing, again, just showing how the prices are going up and it's going to continue to drive. And so this is saying that, theoretically, we should get to about 4% on CPI. Now, this is looking at imports. We have to look at, the U.S. is the largest importing country in the world. U.S. March import prices were up 6.9%, which is the highest since January 2012. Export prices are up 9.1%, which is the highest since September of 2011. So the headline is up 1.2% month over month, after being up 1.3% in February, 1.4% in January. And then the fuel side is up 6.3%, and the core is up 0.8%. So again, taking away year over year and looking at it on a 1 month change, we're heading higher. Because if you take 12 months, so the 12-month price increase is 6.9%, 12-month price changes in import prices, 12-month is up 6.9%, obviously base effect. Then you look at exports, 12-month change is up 9.1%, base effect. But everything else on a month-over-month level is going higher, and it's clipping up at over 1%, anywhere from 1.1% to 1.6%, and even on an export side, 2%. So again, the headline import price inflation, 6.9% year over year, obviously base effect. Core inflation will flirt with 5% in May based on these data points, and this is all based on the Bureau of Labor Statistics. So then when we think of looking at at what is put together by Deutsche, what do you think inflation is going to be? So the U.S., the expectation is between 2% but below 3%, and in the euro area, it's above 1% but below 2%. So again, you're starting to see some of these shifts, but we're seeing some growth in the tail as people are starting to see a bit more of inflation getting baked into their estimates. And then when we look at card spending, so again, this is something that we've talked about when we look at ratio of total card spending for households that receive stimulus, and the retail numbers just came out, and again, we continue to track below 2019. We're not getting back to those levels. Obviously, e-commerce is a bigger part of that, but you're also seeing people are spending the money aren't spending the money as quickly, because at the peak of the moving average, stimulus recipients spent 58% more than non-stimulus recipients in this round versus 65% in the first and 30% in the second. So again, we're starting to see that little bit of an adjustment in terms of what is being consumed. And so there is some of it going into the market, but there's that percentage that is really over 42% going into savings. And what has e-commerce done, and what does that mean for bricks and mortar? What does that mean for what it is? Because in the past, retail wanted you in the store, and now they don't care. They're looking to get you any way possible, and e-commerce has now grown 2 to 5 times faster than before the pandemic. This is a national shift, and this is, a global shift. This is looking at UK, China, and obviously coming from McKinsey, so take it for what it is. But year-over-year growth of e-commerce as a share of total retail sales, UK in 2020 was up 4.5 times, China 1.6, US 3.3 times, Spain 4.7 times. Again, the growth has been exponential, and the fact is, a lot of this is not going to go away. I have a lot of friends that used Instacart, got used to Instacart, now get deliveries every Tuesday, Thursday, whatever. It predicts what you want. It tells you when there's a coupon, a discount. They love it. They haven't been in a grocery store since. So again, these are things that we have to consider when we're looking at gasoline consumption, diesel, because at this point, bricks and mortar is like, if I can shrink my footprint, because what are the 2 biggest costs for a company? Real estate, labor. Can I get rid of my real estate? And can I cut my workforce? Can I cut my labor? And again, this is what we have to consider when we're looking at e-commerce. So then when we look at more people may need to transition to new jobs because we're getting that shift. Again, coming back to the infrastructure plan, the Biden plan, Job training is key, and it's not just in the US. Again, it's a global issue, which is what we've been talking about. McKinsey just so happens to put some numbers around it to look at, okay, well, what is happening in general, and then where are things going to continue to kind of drive higher over the next few months. Then when we look at e-commerce has grown 2 to 5 times faster than before the pandemic in every country, as we continue to see. Again, this is looking at the projected 2019. So if you look at just where the projections are and then where they ended up, you get an idea on just how quickly the adoption has gone. Now, given there are some people that will pare back a bit, but you're just seeing that we were already working up that path. And now this has just accelerated the adoption rate. Again, coming back to also the need for bandwidth. Now, when we look at what is happening in the CRB, or just when we're looking at the commodities index and U.S. core PCE inflation, you can see that the commodity index tends to be pretty predictive, and lumber's now at limit up. We have grains up, and highly, a lot. We have crude up. Now it's come back a bit to 62.92. Again, all of these things are just going to continue to move that inflation index higher. Then when we look at processing inflation, so what are commodities? So what commodities are doing? So producers face surges in prices from chemicals and compounds to lumber and steel. And when we look at phosphates, the highest since 2011, steel mill products, most and on record. Organic chemicals, most since 74, plywood, most since 2005, plastic resins, most since 74, hardwood lumber, most since 1947. Again, all of these things are input costs for a company that are going to raise prices for you. And when you look at plastic resins, as refiners don't run, there's less feedstock to push through. They have to pull condensate from other places, NGLs from other places. This is going to just keep costs elevated. So then when we consider about, CPI month over month, again, looking at just these are the numbers that just came out, where the estimate was for 0.5% month over month. It came in at 0.6%. CPI year over year, estimates for 2.5%. We're at 2.6%. Obviously, the base effect. We want to look at that month over month, which continues to tick higher and is coming up on a runway, essentially. Like, this is something that we think is going to see a big ramp just based on what the leading indicators are telling us. But Americans with the highest incomes see the least amount of inflation. So it comes down to the top 10% are only seeing about 1% of the inflation, because they're the ones that are buying concert tickets, going to sports games, going to sporting events, taking airplanes, going to hotels. All of those things have gotten cheaper, but for the median earner, for the bottom 10%, the things that they buy the most are going higher. So again, how much spare consuming capacity will we have based on this bifurcation in spending? Because the median earner in the bottom 10% is 90% of America. So again, that's going to be some of those headwinds. And then inflation, excluding food and energy, remains tepid while overall jumps. And again, that's why the core, as we look at some of the differences between the two on a month over month level. Now, when we look at what are some of the driving aspects behind it, you can see where energy became the biggest driver, but energy is not going away. So not only on a month over month, but obviously the year over year, we're going to continue to see this push higher. And again, which is why, some people are assuming that it starts to cool off, but based on where crude is right now and where food is going, I struggle to see how quickly some of this is going to cool off, especially as core continues to drive higher. Now, the other thing is rent, because this is effective rent versus asking rent. So if a landlord is unsure of being able to collect rent, it goes in as a 0. So it doesn't make too many zeros to lower the measured rent. So again, there's also when do people, when do we start to see evictions increase? When do we start to see some of these things pick up? which again will start to bring some of this normalcy back as we do see rents going up. Case-Shiller continues to go up 11%. You continue to see home prices go off at the highs. Competition is increasing for housing. Again, these are things that are just going to keep inflation, especially on the rent side, going higher. So then when we look at year over year, this is looking at, again, owner's equivalent rent, primary rent, Case-Shiller. This is where we continue to see some of these pivots in terms of Case-Shiller being a little bit more on the front edge of this. And as we see in terms of just owner's equivalent rent, as the 30-year has gone up, some of that will also start to shift and pull higher. And the other thing is going to be supply chains, empty racks. Retailers' monthly inventory to sales ratio is at the lowest it's ever been, or at least going back to 1992, just given the issues. And again, to compensate for those issues, you're going to have to see more stuff pulled in, more cost, which again is going to increase what people are charged. But consumers continue to increase their travel plans as travel plans ramp up, but they're not forgetting to work. So when we look at like public transportation, still flattish. Airports, again, as we've said, airports flights have started to flatline. And then when we look at car rental hotels, things are getting a little bit better. But when we look at just the overall drivers, this is that top 10% that are going over. So the numbers look good in terms of what people are searching for. I know I build cars on a regular basis, even though I don't buy them. But these are things that have to be considered when we're looking at the overall numbers. And then when we look at producer price index, again, looking at some of the leading indicators, when we want to talk about the demand for commodity types, and we want to look at the monthly side, we want to look at that month over month, you continue to see, again, the producer price index for commodities shifting higher, which again is going to come down to the consumer until the consumer rejects it. And then this is showing something very similar with that pricing, with the ISM manufacturing price going up, which will pull up that core PCE. With the PPI, you want to understand what is actual versus base effect. And that's why we always like to look at the month over month and factor in that base effect model, because we don't want to just say, look, everything's overheating because, look at the year over year. It's like, well, the world stopped for 2 months, 3 months. So we can't really say, look at the year over year. We have to average it out. We have to look at month over month. And then we have to project forward based on a lot of those leading indicators, which I think are very important to consider when we look at what are bonds doing, what are yields doing, because again, we continue to think that yields are going to continue to go up. The long end of the curve is going to continue to grind higher over the next few months.